Picture the trading desks in New York and London.
Oh, man, yeah.
I mean, the rooms are just practically dead silent. You've got hundreds of analysts and portfolio managers, right? And they are just staring at satellite feeds.
And that flashing red countdown timer.
Exactly. A flashing red timer on their screens. Every single tick of that clock represents, billions of dollars in global capital just holding its collective breath.
Waiting for the other shoe to drop.
Right. That was the reality for the global markets heading into an 8 p.m. Eastern Time deadline. This was April 7, 2026. The world was literally bracing for kinetic military strikes in the Middle East.
Yeah, the tension was unbelievable.
But then in a single 24-hour window, the timer just stops.
Completely halts.
The geopolitical map, the traditional financial sector, and the entire digital asset market just completely invert.
It was a tectonic shift. I mean, fundamentally, we went from pricing in a worst-case scenario for the global energy grid to processing this unprecedented institutional land grab in the crypto space, basically overnight.
Okay, let's unpack this. Our mission for this deep dive is to really connect the dots for you.
Right, because there's a lot of moving parts.
So many. We are going to figure out how an averted military strike, a massive $500 million algorithmic short squeeze, and a Wall Street fee war all collided on the exact same day.
It's wild when you put it like that.
It is. And we have to start with the geopolitical trigger, because you really can't understand the explosive market reaction without understanding the sheer terror gripping the global economy just hours prior to that 8 p.m. deadline.
That is the foundational piece here, absolutely. Going into that Tuesday trading session, the global financial apparatus was entirely focused on this rigid military ultimatum.
The U.S. directive.
Right. The U.S. executive branch issued a very clear directive. Iran had to unconditionally reopen the Strait of Hormuz by 8 p.m., or they would face systematic strikes against their power plants.
And civilian infrastructure, too.
Exactly. Actuarial models were going totally haywire, trying to predict what a compromised sovereign energy grid would do to global supply chains.
Right. I mean, the market was pricing in just persistent, crippling inflation.
Oh, absolutely.
But then, less than 2 hours before the deadline, the U.S. suspended the planned strikes.
Yeah, at the 11th hour.
They agreed to this conditional 2-week ceasefire framework, the Islamabad Accord, which was brokered by Pakistan.
Though we should note, Israel did confirm their operations in Lebanon will continue.
Right, so the region isn't entirely clear. But the Strait of Hormuz reopened under Iranian military coordination, and the immediate reaction in the commodities market was just visceral.
It was a freefall.
Brent crude oil plummeted 13 to 15%. It dropped right below that $100 mark, oscillating around like $94.10 to $95 a barrel.
If we connect this to the bigger picture.
Please do.
Well, if you're listening to this and wondering, why an averted strike in Iran and a drop in crude oil matters to a digital token on your phone, here is the connection. Crude oil is the ultimate input cost for everything.
Everything in the physical world, yeah.
Right. When crude was surging above $111 a barrel, it threatened to create sticky supply-side inflation. And when inflation runs hot, central banks are forced to keep interest rates high.
Which drains cash out of the system.
Exactly.
It's like the crude oil market is the financial weather forecast, right?
Right.
When oil is expensive, the forecast calls for a drought in global liquidity.
That's a great way to put it.
But when oil drops 15% in a matter of hours, those inflation storm clouds suddenly start clearing up.
And Bitcoin behaves like a giant sponge for excess cash in the financial system. So when energy input costs stabilize, it severely drops the expected consumer price index.
Meaning central banks can pivot.
Right. Theoretically, they have the runway to print money or lower rates again.
Yeah.
That is the perfect macroeconomic tailwind for an asset designed to absorb fiat liquidity.
Hold on, I'm stuck on one detail here.
Yeah.
The ceasefire under the Islamabad Accord is only for 14 days. If the inflation storm clouds are clearing, does that mean Bitcoin automatically gets sunny skies? Or are we just ignoring the fact that a ceasefire is only temporary?
That is a crucial distinction, yeah. The ceasefire establishes a localized, temporary window of suppressed volatility.
Just a pause, really.
But in modern automated trading, 14 days of structural relief is an eternity.
Golly, 2 weeks.
Oh, yeah. It provides more than enough time for capital to violently rotate back into risk assets, which leads directly into the microstructural mechanics we saw play out in the order books.
Here's where it gets really interesting.
Yeah.
Because that sudden geopolitical relief collided with a market that was heavily positioned for a total disaster.
Everyone was bracing for impact.
Right. Pre-ceasefire, Bitcoin had hit an intraday minimum of, $67,724.
Yep.
Traders were just piling into leveraged short positions, basically betting on a broader regional conflict dragging the price down.
They were heavily burdened by aggressive tactical positioning. I mean, they assumed the 8 p.m. deadline would trigger a massive sell-off.
A bloodbath.
Right. But when the newswire started broadcasting the framework of the Islamabad Accord, quantitative algorithms and high-frequency trading engines just rapidly recalibrated.
They started aggressively buying to front-run the diplomatic relief.
Exactly. And that triggered an absolute explosion.
Yeah, the price violently surged 7.4% to a high of 72,760.
That's a massive swing.
To put the forensic liquidation data in perspective, in a matter of minutes, algorithmic short sellers lost more money betting against Bitcoin than the entire GDP of some small island nations.
It's staggering when you look at the time.
Between $595 and $610 million in forced margin closures occurred.
Just wiped out.
Short sellers specifically accounted for $431 million in liquidations, and $214.8 million of that was just in Bitcoin. Walk me through how a squeeze of that magnitude actually works under the hood. It's like people holding the door shut on a crowded train, right?
Yeah, and when they finally let go, the crowd surges forward uncontrollably. You have to look at the mechanics of centralized exchange margin engines.
Okay.
When those initial spot algorithms started buying the geopolitical relief news, the price naturally ticked up.
Sure.
As it ticked up, it hit the tight stop-loss orders of the over-leveraged short sellers. At that point, the exchange's automated risk engine takes over to protect itself.
Oh, wow.
It forcibly executes market buy orders to cover those underwater shorts.
Ah, so it's not even a human making a decision to cut their losses at that point.
Not at all. It creates a synthetic, price-insensitive bid.
Price insensitive.
Right. Think of it like a wild bidding war for a house. But one of the buyers is contractually forced by a bank to keep bidding higher and higher, no matter the price, until they win.
Because they have to close the position.
Exactly. These engines don't care about getting a good deal. They just consume all available sell orders until the bad position is closed.
And that drives the price up even more.
Which triggers the next guy's stop loss, forcing another automatic buy order. It's a complete chain reaction.
So wait, now that $431 million of short interest has been evaporated, what happens to the market when we no longer have those short sellers around to provide synthetic liquidity?
That's the billion-dollar question.
Doesn't that make the current price incredibly fragile?
That is the exact vulnerability of the current price level, yes. The order books are now devoid of the synthetic liquidity that those short sellers would have eventually provided when they voluntarily bought back in.
Right, because they're already gone.
The market is now entirely reliant on organic, genuine demand to maintain that baseline. If the diplomatic negotiations in Islamabad hit a wall on day 15, the market is highly susceptible to a sharp pullback.
Which makes what happened the very next morning so critical to the organic demand you just mentioned.
Oh, the timing was unbelievable.
Right. Because while the spot price was squeezing in real time, the long-term structural runway for the asset was being paved over by two monumental developments.
In legacy finance and U.S. regulation.
Exactly. First, the SEC entirely shifted its posture. Under the new Chairman Paul Atkins, they formally capitulated on past enforcement doctrines.
It was a historic revision of their fundamental regulatory architecture.
They completely dismissed 7 major actions against pillars of the industry. We're talking companies like Coinbase, Binance, Kraken.
And they admitted their previous 95 enforcement actions provided zero tangible investor benefit.
Which brought in $2.3 billion in penalties, by the way. Now they have a new safe harbor framework heading to the Office of Information and Regulatory Affairs.
Right, to OIRA.
It's like the SEC just ripped up the speed limits. But what does a safe harbor actually change for a traditional bank?
It changes the entire compliance checklist. Historically, compliance officers within major banking entities restricted client exposure because of legal ambiguity.
They didn't want to get sued.
Exactly. They were terrified of secondary liability. By formally retracting these actions and establishing a safe harbor, the SEC is actively compressing that regulatory risk premium.
Okay.
The compliance departments finally have the definitive legal clarity they need to authorize broad portfolio integration without fearing government retribution.
Which clears the path for the second major development. Literally the next morning, April 8th, Morgan Stanley officially launched the Morgan Stanley Bitcoin Trust, or MSBT, on the NYSE Arca.
Yeah, that was massive.
And they designed this thing to cannibalize the market. They launched with an aggressive annual management fee of 0.14%.
Undercutting BlackRock's 0.25%.
Right. Does that tiny fraction of a percent really matter that much?
Oh, the fee compression is vital.
Yeah.
You have to understand why that specific 11 basis point difference is so destructive to competitors.
Okay, why?
For massive institutional allocators acting on behalf of clients, they are legally obligated to find the most cost-effective vehicle.
Fiduciary duty.
Exactly. That 11 basis point arbitrage legally justifies migrating billions of dollars of capital away from BlackRock and Fidelity.
And Morgan Stanley didn't just lower the fee. They unlocked direct distribution access to their 16,000 internal wealth advisors,
who oversee $9.3 trillion in client capital.
So while the SEC ripped up the speed limits, Morgan Stanley simultaneously opened a 16,000-lane highway straight to $9.3 trillion.
That internal distribution pipeline is the real game changer. Previously, advisors faced internal friction and complex fee layering rules if they wanted to recommend a third-party ETF to a client.
But now they have their own.
Now they are heavily incentivized to allocate directly into MSBT, keeping all the administrative fees in-house.
Does this aggressive fee war mean the legacy banks are officially going to cannibalize the crypto-native platforms? Are they effectively taking ownership of the asset class?
They are certainly capturing the accumulation process.
Yeah.
I mean, the localized $159 million in ETF outflows we saw on April 7, like Fidelity's FBTC losing $47.8 million, that was just tactical macro hedging.
Right. People getting scared of the missile strikes.
Exactly. It was vastly eclipsed by Morgan Stanley's new distribution pipeline. The underlying decentralized asset remains the same, but the distribution architecture is absolutely shifting to legacy wealth management.
So we have Wall Street rewriting the rules of access, the regulator stepping back, and the price squeezing upward.
Yep.
But beneath the surface, the actual physical machine running this network and the entities holding the oldest coins are exhibiting some bizarre anomalies.
Unprecedented, really.
Let's look at the physical reality first. Due to the infrastructure strikes in the Middle East, Iran's sovereign mining hash rate plummeted by 77%.
We're talking about 427,000 ASICs taken offline.
What does that do to the network?
What's fascinating here is how that localized destruction exposed a broader thermodynamic shift. Global hash rate dropped to 1,004 exahashes per second.
Wow.
And it's a severe profitability crisis. The hash price plunged to extreme lows of around $27.89.
So efficient operators like CleanSpark are surviving, but others are fleeing to jurisdictions like Oman or Paraguay, or they're pivoting entirely out of crypto.
Right, the AI pivot.
The intel shows the AI firm Anthropic just secured 3.5 gigawatts of computing resources from former crypto miners.
It's a massive reallocation of energy.
So what does this all mean? It's incredibly ironic that cutting-edge AI firms are fighting over the exact same electricity grids as Bitcoin miners.
It comes down to revenue certainty. Leasing massive energy infrastructure to an AI developer offers predictable fiat returns.
Are we looking at a future where Bitcoin mining is just a weekend side hustle for massive AI server farms when they have spare power?
It is a highly probable outcome for mid-tier operators. AI provides the reliable baseline cash flow to keep the lights on.
And crypto mining is just the bonus.
Right. But while the physical layer of Bitcoin is being lured away by AI, the narrative layer of the network is facing its own awakening.
Yes, the Gen Z retail traders aggressively using MicroStrategy equity as a proxy, for one.
And whales.
Oh man, the on-chain forensics. A whale wallet that had been completely dormant since 2020 suddenly mobilized 10,603 Bitcoin.
Worth $1.26 billion.
Why move it now?
The mobilization of $1 billion multi-year dormant cohort usually correlates with advanced over-the-counter distribution to institutional buyers. It injects a massive tranche of previously untouched supply into the active network ecosystem.
And as if a billion-dollar ghost ship waking up wasn't enough narrative shock for one day, we also got a massive investigation from the New York Times,
Ah, the Satoshi investigation.
pointing to British cryptographer Adam Back as the likely creator of Bitcoin, Satoshi Nakamoto. They cited 67 specific linguistic formatting matches.
Advanced stylometric analysis. They aren't just looking at what he said, but how the code and text were physically structured.
Back denies it, of course. But whether it's true or not, it injects profound narrative tail risk into the market. Because Satoshi's early wallets hold an estimated 1.1 million dormant Bitcoin.
Both represent massive dormant collateral suddenly awakening.
It's almost too much to process. Over a single 24-hour period, we saw a global military conflict averted at the 11th hour.
Sending oil plummeting.
Right. We watched $500 million in over-leveraged shorts brutally crushed in an algorithmic squeeze.
Yep.
We saw the SEC formally wave a white flag, and Morgan Stanley unleash 16,000 wealth advisors.
Unbelievable timing.
And on top of all that, the ghost of Satoshi making front-page news.
It perfectly illustrates why you have to look beyond the daily price ticker.
For you listening, to be well-informed today, you can't just watch the price tracker on your phone.
Yeah.
You have to understand that the entire structural architecture of this market just transitioned from defensive to offensive overnight.
Fundamentally shifted.
But it leaves us with a lingering question. With Morgan Stanley's traditional wealth advisors now actively pitching Bitcoin and miners leasing their rigs to AI companies, are we witnessing the final stage of Bitcoin's financialization?
That's the real thought experiment.
What happens to the revolutionary cypherpunk soul of the network when the legacy Wall Street suits and corporate AI algorithms finally become its biggest stakeholders? Something for you to mull over until our next deep dive.